Have you ever opened your investment app and felt like you were trying to read a map written in an alien language by a sleep-deprived economist? It happens to the best of us. When the average person logs into their workplace retirement portal for the first time, they are bombarded by a chaotic list of fund titles that look like someone spilled a dictionary on the floor. You see terms like small cap aggressive, international blended value, life cycle horizon dates, and buried somewhere in that jumbled mess is an option labeled S&P 500 Index Fund. Now, if you exist in the modern world, you have likely heard the phrase S&P 500 tossed around more often than a frisbee at a park picnic, but you might be unsure of what it actually is or why it matters. Maybe you caught a glimpse of it on a news ticker during a market boom or a crash. Perhaps that one colleague who swears he is the next big stock picker won't stop rambling about it near the coffee machine. Regardless, you are likely asking yourself if this cryptic S&P 500 concept is a legitimate path to wealth or just another piece of financial jargon meant to make you feel confused. Well, the reality might shock you. The S&P 500 is not a haphazard grab bag of shares selected by bankers throwing darts during a dull Friday meeting. It is arguably the most critical gauge of the American economic engine, and grasping how it works could be the deciding factor between a stress-free retirement and working until you are 95 because you believed investing was too hard to learn. My name is Nick, and I dedicate way too many hours to analyzing wealth, markets, and why most folks would prefer to scrub their floors than study their portfolio. If you are looking to build serious assets without needing a finance degree, go ahead and smash that subscribe button and like this video to help us demystify the money game for everyone. Here's the secret about planning for your future that nobody mentions. Most of us will switch careers a dozen times, and every single time we move, we get handed a fresh menu of confusing investment choices that look nothing like the previous ones. One employer gives you 10 options, another gives you 60. Some use flashy titles like high-octane growth, while others use dry labels like preservation trust. But hidden in that noise, you will almost always spot an S&P 500 tracking fund. This fund is ubiquitous not because financial firms are lazy. It is everywhere because the S&P 500 represents the gold standard of the equity world. Imagine it as the ultimate all-star team of American capitalism. But instead of voting for the most popular player, we are tracking the companies that are actually worth the most cold, hard cash. Before we unpack why this index is so unique, let me pose a question. When you picture the dominant businesses in the United States, who do you see? You are likely visualizing giants like Apple, Microsoft, Amazon, Google, Nvidia, or perhaps Netflix and Tesla. These are not just brands you recognize, they are forces that have completely rewritten how we communicate, work, and shop. Well, here is the kicker. Every single one of those titans is sitting right inside the S&P 500. When you buy into an index fund, you are effectively purchasing a slice of all of them simultaneously. Now, you might be skeptical, thinking, that sounds too easy. How can a single ticker symbol give me ownership in hundreds of the best businesses on Earth? And if it's that simple, why isn't every neighbor on my street doing it? These are valid doubts, and they lead us directly to the core reason why the S&P 500 is essential for anyone playing the long game. The S&P 500 is an index, which is just a fancy tool for tracking the performance of a specific basket of stocks. Just as a thermometer tells you if you need a jacket or a swimsuit, the S&P 500 tells investors the temperature of the broader market. But unlike the weather, which only describes today, this index reveals the long-term trajectory of the nation's economy. Here is where the plot thickens. The S&P 500 does not just blindly grab 500 corporations and call it a day. There is a committee of serious analysts who dedicate their careers to scrutinizing businesses to decide who gets a velvet rope pass into this VIP club. Picture them as the strictest bouncers for the most exclusive party in the corporate world. But instead of checking shoes and shirts, they are checking market value, liquidity, and earnings reports. To earn a badge in the S&P 500, a firm must clear some high hurdles. They must be a US-based entity. They need a market cap in the billions, and they must show a profit in their most recent financial quarter. They also need to have been trading publicly for a year or more, which filters out the flashy startups that might explode and vanish overnight. This rigorous vetting process is a huge reason why these funds have dominated for decades. You aren't gambling on unproven penny stocks. You are backing companies that have already demonstrated they can navigate and win in brutal industries. It is like having a squad of expert scouts draft your fantasy team for you. Except instead of trying to win a plastic trophy, you are trying to secure your financial freedom. But there is a twist in how the S&P 500 functions that might catch you off guard. Although it holds 500 names, they are not on equal footing. The larger and more valuable the enterprise, the heavier its impact on the index's movement. So if Apple rallies and its price surges, it lifts the S&P 500 far more than if a smaller airline or clothing brand jumps by the same amount. This means the top 10 massive players actually dictate nearly 40% of the index's direction. We are talking about the tech kings like Microsoft and Amazon, alongside stalwarts like Berkshire Hathaway and Johnson & Johnson. When these leaders thrive, the index flies. When they stumble, we all feel the bump. Now, having so much weight on the big guys isn't necessarily a flaw. These are organizations that have proven they can print money and generate massive cash flow. They have weathered recessions, pivoted with technology, and kept expanding while their smaller rivals collapsed. In many ways, betting on the S&P 500 is simply a bet on the endurance of American innovation. But here is the truly fascinating part. The secret that most commission-hungry advisors will never whisper to you because it hurts their bottom line. The S&P 500 possesses a scorecard that makes most professional fund managers cry into their silk handkerchiefs. Over the last few decades, this supposedly boring, robotic index has routinely crushed the vast majority of active traders, despite those traders having Ivy League diplomas and unlimited research budgets. Let that sink in. You have armies of brilliant professionals working 80-hour weeks, analyzing balance sheets, interviewing CEOs, and trying to forecast the next big winner. They are paid millions to outperform a simple list that follows a strict set of rules. And yet, year after year, most of them fail miserably. It is like watching a grandmaster chess player lose to a novice who is just following a cheat sheet they found on Reddit. The data is brutal for the active management industry. According to reports from Standard & Poor's, over a recent 15-year stretch, roughly 90% of active large-cap fund managers failed to beat the S&P 500. 90%. That means if you handed your savings to 10 random experts, 9 of them would have delivered worse results than if you had simply bought an index fund and gone to sleep for a decade. You might be asking, how is that physically possible? How can a mindless fund beat a human who lives and breathes the market? The answer is buried in a concept that sounds dull, but is actually mind-blowing once it clicks. It is known as the efficient market hypothesis. While that term might put you to sleep faster than warm milk, the logic is simple. The idea is that stock prices instantly reflect every scrap of available data. When news breaks that a tech giant has a breakthrough patent, that info is baked into the stock price in a microsecond. There are thousands of sharks in the water, watching every headline and every data point, looking for mispriced assets. But because there are so many geniuses hunting for the same prize, it becomes nearly impossible for any single person to consistently find the gold nuggets that everyone else missed. It is like trying to find a dropped $20 bill on the floor of a crowded station. Sure, it happens, but with thousands of eyes scanning the floor, that money disappears instantly. The market is the same, but instead of cash, investors are hunting for bargains. And today, supercomputers snatch up those bargains in nanoseconds. This leads us to a golden rule of investing that is rarely taught in school. Winning isn't just about picking the winners, it's about not overpaying for the game. And the fastest way to lose is to pay high fees for performance you could get for pennies. When you buy an actively managed mutual fund, you are often charged an expense ratio of 1% or 2% every year. That sounds tiny, right? Well, let me frame it in a way that will make you rethink every contract you have signed. If you put $10,000 into a fund charging 2%, you lose $200 a year. If that pot grows to $100,000, you are now handing over $2,000 a year. If you hit $500,000, you are donating $10,000 annually to the manager. You are effectively buying your fund manager a luxury vacation every single year for the honor of them likely underperforming a generic index fund that would cost you $3 for the same service. But the fee trap gets worse due to the reverse magic of compound costs. Those fees are deducted annually, meaning that money is gone forever and cannot grow. If you had kept that fee money invested instead of donating it to Wall Street, it would have compounded into a massive sum over 30 years. High fees can quietly strip hundreds of thousands of dollars from your final nest egg. This is precisely why Warren Buffett, the Oracle of Omaha, has constantly advised regular people to buy S&P 500 index funds. He was so certain of this truth that he placed a legendary wager against the hedge fund industry. Buffett bet that a simple S&P 500 fund would crush a hand-picked basket of elite hedge funds over 10 years. The hedge fund managers, arrogant in their expertise, took the bet, assuming they could easily outmaneuver a dumb index. 10 years later, Buffett secured a crushing victory. The index fund returned over 7% per year, while the hedge funds scraped by with less than 3% after their hefty fees. Remember, these weren't amateurs. These were the supposed masters of the universe, and they got demolished by a strategy that requires zero effort, zero stress, and zero predictions. The elegance of index investing is that it eliminates the human errors that destroy portfolios. You don't have to worry about a manager getting reckless with your cash. You don't have to worry about style drift, where a fund changes its strategy in secret. You don't need to track who is running the show. Instead, you get something wonderfully boring and reliable. When America wins, you win. When the economy stalls, you stall. But over the long haul, American business has shown an incredible knack for adapting and expanding, which translates to wealth for index holders. Let's translate this into cold, hard cash, because this is where the S&P 500 stops being a theory and starts being a freedom machine. For nearly a century, the S&P 500 has delivered an average annual return of roughly 10%. Some years it soars 30%, other years it tanks 20%, but the long-term trend line is relentlessly upward. A 10% return may not sound like a lottery win until you see the math of compounding. If you invested $1,000 a month into this index starting at 25, by age 65, you would have put in $480,000 of your own cash. But your account? It would likely sit around $2.6 million. That extra $2.1 million wasn't from you working overtime. It came from owning a piece of the economy and letting the snowball effect roll for 40 years. It gets even crazier. Consider your real timeline. Most folks get serious about money in their 30s, leaving them 35 years to grow. During that span, you aren't just making money on your savings, you are making money on the money your savings earned, which then earns more money. It creates a financial avalanche. Suppose you are 30 and you max out a Roth IRA with about $7,000 a year into the S&P 500. With that historical 10% average, by 65, you'd have put in roughly $227,000. But your balance would be around $1.4 million. That is over $1 million of free wealth generated just by having patience and ownership. Now, I can hear the cynics. 10% is a fantasy. What about the crashes? You are right to be cautious. The market does not hand out gains like a candy dispenser. We have years where the board lights up red and portfolios drop 25%. And when that happens, checking your balance feels like watching your car roll off a cliff. But here is the secret about volatility that veterans know. Those terrifying drops are actually your best friend if you are still buying. It feels wrong, but bear markets are essentially clearance sales for wealth. When stocks crash, your monthly contribution picks up way more shares. Then, when the recovery happens, and it has happened after every single crash in history, those cheap shares you grabbed in the panic become your most profitable assets. Think of it this way. If you walked into a steakhouse and saw the menu was 50% off, you wouldn't panic and leave. You would order 2 steaks. The same logic applies here. When the market dives, your dollars buy double the equity. When prices normalize, you own a much larger slice of the pie than if the market had just stayed flat. This is why rich investors don't fear crashes. They exploit them. They know volatility is the price of admission for superior returns. It's like enduring a bumpy flight because you know you are landing in paradise. But let's talk about the final trap, the sales pitch you will hear from every commission-based planner. They will admit the S&P 500 is okay for beginners, but then claim you need sophisticated tactics. They will use buzzwords like tactical allocation or alternative alpha. They will show you a graph where their fund beat the market during one specific 3-year window. Here is what they hide. Those charts almost never account for the fees and taxes that eat your profits. They also ignore the fact that past luck does not predict future skill. Despite the legal warnings on every brochure, the industry thrives on the lie that complexity equals quality. An advisor cannot charge you a fat fee for telling you to buy one index fund and hold it for 30 years. There is no meeting to schedule, no charts to review, and no reason for their bill. But they can definitely charge you for constantly shuffling your money, moving between funds, and executing complex plays that sound genius, but usually lose to the simple path. This forces you to answer one question. Do you want to sound smart, or do you want to be rich? Because often, being rich means embracing the boring, unsexy strategy that works. It means accepting that you don't need to outsmart the world to own a piece of it. It means understanding that trying to be clever is the fastest way to become poor. So there it is. The S&P 500 isn't a magical puzzle. It is simply a way to own the backbone of the American economy without doing homework or paying a guy in a suit to guess the future. Whether you go all in on the index or mix it up is your call. Just remember, the best plan is the one you can stick with through the storms, not the one that sounds impressive at a cocktail party. If this helped you see through the noise, do me a huge favor. Hit that like button and let me know in the comments. Are you team passive or team active? This is Dave Invest, and I'll see you in the next one.